Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. In this webcast series, we talk about options trading, and we're entering kind of a delicate period for options traders. We're looking straight in the face of earnings season, and for some options traders, they prefer not to get involved. They prefer to just sidestep earnings. As a matter of fact, I saw somebody chat in even before this webcast started. I prefer to not trade over earnings announcement. Well, today we're going to be talking about trading long call vertical spreads, but avoiding earnings, navigating through the earnings season. So it should be an interesting discussion. We're going to be using example trades today. We're going to have an example list of priorities that a trader might meet, how they might execute that in a trade, how they might place the trade from start to finish. There's a lot to cover. It should be fun discussion. Even if you're new to this approach to trading, I think I'll try to go at a pace that everybody can follow. But before we get to any of that, though, let me first of all say hello to everybody out there on YouTube. Great to see so many familiar names and so many new names. Hello there, Miralai and Hector, Will, Ricebird, Ted, Do Not Copy, Naresh, Don, Life in the Fast Lane, Frank, and everybody else. Thanks for joining us week after week. If you're one of our returning veterans, if you're here for the very first time, I do want to welcome you as well. I hope you put it in your calendar to make it a regular thing to attend one of our live sessions, or you can just always check out the archives. Vast majority of our webcasts are also archived. I'll show you where to find that. If you're watching on the YouTube archives, I also want to let you know that you're invited to join us in the live discussion. This is a Thursday webcast series. We kick things off promptly 11 Eastern time. We would love to have you here in our live stream audience. And as a special treat for our live stream audience members today, I have my very good friend Brent Moores. He's hanging out in the chats with us. Brent's going to be addressing any questions that I can't get to just during the natural flow of the presentation. As long as they're not too far off topic, Brent's there to pick up my slack. So thanks for doing that for me, Brent. And also, Brent and I would like to issue an invitation to everyone listening. If you have an account with X, you should be following your favorite presenters there. It's the best place to connect with us. In between these live streams, you can find Brent there at Brent Moores CS. You can find me there on X at Cameron May CS. I've probably chatted back and forth in those posts with about 30 different people over the course of the last 24 hours. Great place to connect. Anyway, let's get into this. And of course, as we do, there are risks to be considered. Trading and investing certainly carries risk. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including a loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's talk about what we're going to talk about. We have about 45 minutes to spend together today. Let's lay out an agenda. Really just three things I want to cover. I do want to take a quick glance at existing positions in our paper money portfolio and look at markets, okay? We do want to get some context for this discussion we're having today, but we're going to dedicate the bulk of our discussion to planning and placing a long call vertical spread in earnings season. How might a trader navigate that? So for today's discussion, we're going to have three priorities for our trader. Number one is avoiding earnings. Number two is we're going to be planning a high probability trade, balancing that with at least an adequate reward potential in that trader's view. And then finally, we want to make sure that we have a risk management plan for that trade even before the earnings announcement ever hits. Right? So let's go right to our Thinkorswim desktop platform. So if you are new here, looks like we have 351 people watching live right now. Do me a favor, chat in and let me know, are you familiar with a long call spread? Just yes or no. No embarrassment should be associated with not being familiar with every strategy under the sun, because everybody's somewhere along their own personal learning curve. But as you chat that in, I want to give you a heads up. Today's presentation is going to be done using something called Thinkorswim Desktop. It's trading software that's available free of charge. You just download it from within your Schwab Online account. All you'd have to do is go to the Trade tab up at the top in your Schwab Online account and look for Thinkorswim in the drop-down menu, okay? All right, so I'm getting a lot of yeses, a lot of nos. for this strategy. That's what I would guess. I know my audience pretty well. I know that a lot of you, well, due to the nature of the webcast series, a lot of you are already familiar with something else, a long call vertical spread. It's a regular participant in this webcast series, but not everybody knows about the strategy. So I will explain the strategy as we go. But the first thing that we're going to do, just for those that attend each week, I want to take a quick glance at our current positions. We're not going to be making any changes to those positions. We typically do. Not going to make any changes today, just in the interest of time. But also, so the first of our three positions here is Amazon. Now that we bought a 215 call, we sold a 220 call. That is a long call vertical spread, just like what we're going to be trading today. The preference here is for our stock to be above those two strikes. So 220 is the higher strike. We'd like our stock to be above 220, and you can see right now it's at 221. So the stock is actually participating just fine. We're looking at right now an unrealized gain of $475 on that trade. I'm going to let it continue to work, not going to make any changes to that. But as we go through the rest of these, if you are here for the first time, here's a big heads up. This is a great way to learn stuff. If you see something that a presenter's talking about and you think, I don't know what that is. Well, this Amazon trade and this Gilead trade, this NVIDIA trade, we put these on in a live webcast just like this one, and those are now in our archives. So if you haven't done this already, go down in the lower left-hand corner of your, or lower right-hand corner of your screen. I'm pointing my left just to get you oriented correctly. Anyway, there's a little button that says subscribe. So subscribe to our Trader Talks channel. It only takes a second to click that button. It doesn't cost anything. But when you've subscribed to our YouTube channel, that's where we house all of our previous webcasts. So here's the name of our channel. It's called Trader Talks Schwab Coaching Webcasts. So you can just look that up on YouTube. And then you can find the playlist right here on our homepage. You can also, of course, join our live streams. But if you can't make them, just come to the playlist. And as an example here, if you want to go back and look at those trades that we already have in place, you can just scroll on down, look at all these webcast series we have. You can find one that suits your particular preferred way to approach the markets. But mine is more toward the bottom. It's a third up from the bottom, long verticals and diagonals. If I click on View Full Playlist, here I can see, like last week, we talked about using stock charts to plan a diagonal spread trade. So that's where you're going to find all of these, including the trades that we're discussing. All right. Now, another thing, I might as well point this out. Another thing you can do, let me hit the back button here. If you have a particular interest, like somebody chatted in before the webcast, said, when is somebody going to talk about butterfly spreads? Well, come to our channel and type in that keyword that we're interested in. And I already posted this to the chats, but there's Brent Moore's talking about the basics of butterfly spreads. So yeah, lots of great resources there. But let's get back to our current positions. Amazon's doing just fine. Gilead's also doing just fine. In this case, we bought a $95 call that has 700 days until expiration. And then at the same time, we sold a 115 call with just 8 days now left till expiration. This is a long call diagonal spread. With this trade, the preference is for the stock to go up, helping the call that we purchased keep going higher and higher and higher. But we'd really like the stock to stay below 115 and allow that short option to just expire worthless, hopefully. And if you'll notice here, it's pretty much what it's doing. Stock's at 114 and change. We have that preference for it to go up to 115, but stay there below that, hopefully for the next 8 days. So I'm going to leave that one alone. We'll talk about it next week. That should be interesting. NVIDIA is another long call diagonal spread where we bought a 145 longer term call, sold a 170 shorter term call, and here the preference is for the stock to go up as close to 170 as it can, but stay below that through the 18th of July. Right now we're at 162. So that one's doing fine too, up about $200. The one that is not doing fine, well, Joe says, can you compare the pros and cons of the Greeks on a long vertical compared to a long ratio back spread? Joe, that's a great question. It would take me, unfortunately, way too much time to do that question any justice. If you want to learn about Greeks, though, you could definitely go to the YouTube channel and type in Greeks. If you want to learn about ratio spreads, you can go to the YouTube channel and type in ratio spreads. That would take me the full 45 minutes to give that good answer. Okay. Anyway, the one trade that has been misbehaving right from the start, and yet we've been stubbornly sticking with it because that's what we said we were going to do, is UNH. With UNH, we bought back on the 1st of January a $520 call, a 520 strike call that had about 2 years on the contract. And the premise of this trade, sometimes I just like to ask interesting questions just to ask them. So here's where we took our trade. You can see right here, it says the 520 long call was purchased here. These are just drawings I made on the chart so you can see the logic of the trades. Anyway, on January 9th, we threw out this question. What if a trader just took a trade and just stubbornly stuck with it for the whole year, no matter what happened? Well, this is what can happen. If we make those decisions in advance and we have no plan along the way, stocks can collapse, even on bullish trades. The stock doesn't care that we have a bullish trade. Now, along the way, let me expand our chart a little bit. I'm going to click on the right margin and just drag that up a little bit. It's sort of spreading this out so I can see these other details. So we own this long call. Along the way, we've sold some short calls against that, creating diagonal spreads again. And we've collected about $2,000 worth of premium along the way. So, yep, we're underwater about $9,000 on the long call, but we've already realized gains of about $2,000 on short calls. So that helps. Doesn't make it all okay, though. Right now, we're in a 530 short call. But, right here's where I went on vacation, and the stock just continued to misbehave. Well, we decided we're going to just see what happens with this one. This is what can happen. I think there's a good lesson in this. If a trader, let's say they just essentially fall in love with a position, they say, no matter what happens, I'm going to make this one work. Sometimes we can't make it work. All right. Anyway, there we go. Now, if you want to go back to that January 9th webcast, that'd be interesting. You can see we were talking about doing just this. Let's just put it on, try to make it work, no matter what happens. Great lesson there. Anyway, that brings us to let's plan and place a new trade, but recognizing that we're moving into earnings season, and for some traders, they just prefer not to deal with earnings. So let's first of all see what's going on with the S&P 500. I'm not going to spend a lot of time here because it's not going to be a huge surprise to many people that we're trading within a fraction of a percentage point of all-time highs. So we're going to be doing a bullish trade under the premise that our hypothetical trader here just thinks that once a trend is established, it's just more likely to continue than not. They're trying to move the odds in their favor. Now, markets can turn on a dime. We all know that. That's what they did back here in February. But for a long time before that, they didn't turn on a dime, aside from, some fits and spurts along the way. Salient Joe says, at what point do we call mercy? I think we understand the lesson. Well, Salient Joe, I'm not going to call mercy on that one all the way through the end of the year because that was the original plan. But it kind of puts a highlight, underscores the potential logic of having an exit plan. So here's what we're going to do. As we turn our attention to planning an example trade for the day, we're going to have 3 objectives for that trade, 3 priorities, okay? But let me finish. Just a quick comment here. What do we note technically on the S&P 500? Well, there's a previous broken price ceiling. For some traders, that can give some additional bullish emphasis to their outlook. When we're breaking through what appear to be important price ceilings, maybe that'll provide new price floors if stocks retrace. Another trader might look at this, and I'm going to talk about this later today, where we've run up over about 2 weeks and then pulled back for a couple of days and we're advancing again. Some might see that as what's known as a bullish flag formation. But bottom line, whatever the trader's technical convictions are, let's just say that our trader is looking to plan a new position somewhere out, into late July, maybe August. The question that they might be asking themselves is, well, do we think that stocks generally are heading higher or lower? Because if stocks are generally heading higher and I'm doing bearish trades, that could be tough. If stocks are generally heading lower and I'm doing bullish trades, that could be tough. So today's trade is going to be bullish. Let's just say that our trader thinks this sort of a thing is going to happen. We're going to go higher. All right, so let's plan and place a new trade. But as we do, let's have some example priorities. Okay. Let's make this bold so we can see it a little bit better. There we go. But our hypothetical trader here, let's say that we have a few priorities. Priority number one is to avoid earnings. Let somebody already chat in today and say, I just tend to avoid earnings. I'm not saying that every trader should. Some traders not only are okay with trading through earnings, they may actually sculpt their trades specifically around an earnings announcement, like to ride it through. They think that that may actually assist the trade. Maybe that'll be a topic for a future discussion. But today we're kind of sidestepping. We're trying to step over what might be viewed as landmines. Okay, number two is we're trying to balance a high probability trade. Let's say that our trader prefers high probability scenarios, more wins than losses, but balancing that with, let's call it adequate reward potential, sufficient reward potential for however the trader might determine that. Okay. And then number three, having a risk management plan. Even if we've taken earnings out of the equation, there's still risk in the trade. We can't just pat ourselves on the back and say the job is done. So, BebGeo says, I don't know anything about options. Where do I start? Are there in-person classes? Not in-person classes, but I have an excellent suggestion for you. Number one, I've already said this once, but if you haven't subscribed to our YouTube channel, do that now, because we have a series that's dedicated to that. But let me show you. If we go to that channel and we go to the playlists, I'm going to make a couple of recommendations here. If I scroll down just a little bit, you'll see, first of all, this is the first one I wanted to show you. If you're new to using Thinkorswim, there's a little list of lessons that I put together for really understanding Thinkorswim. A little bit further down, actually a lot further down, there's a webcast series called Getting Started with Options, right there. Getting Started with Options. If I view that full playlist, yes, yeah, your instructor here is me. But what I would suggest you do, if you're brand new, go to this playlist and scroll down a bit, and you're going to find a series of lessons that start at the beginning. Lesson number one, trading options building block number one, long calls. I just start with the basics and build. Okay? My pleasure to show you that. Yeah, make sure that you're availing yourself of all of the resources that are available to you for the education. A lot of fabulous stuff out there. Anyway, I didn't want to click play. Back it up, back it up. I just wanted to go back here. There we go. But here are our priorities for our trade. Avoid earnings, set up a trade that has a high probability of success, but that also offers, in the trader's view, how about we throw this in quotes just to know that this one has some discretion, an adequate reward, and then have a risk management in place, risk management plan in place. So here's an example stock that we're going to be using for today's trade. Maybe you've heard of it, called Apple, trading symbol AAPL. I'm being a little bit facetious there. You might be asking, Cameron, how did you select Apple out of all the stocks out there? Well, traders can have a number of pre-qualifiers that they might go through before they commit to a trade, like planning an options trade. Some common ones, this is not going to be an exhaustive list because there's a lot of different ways that traders might view this, but some very common ones are to make sure that the stock is highly liquid. Illiquid stocks tend to have illiquid options that can lead to all sorts of issues with the pricing of the options, make them hard to get into, make them hard to get out of, just make them harder to trade profitably. So traders might have that emphasis on liquidity. Well, Apple happens to be one of the most liquid stocks in the world, one of the most heavily traded stocks in the world. That's what I mean by liquidity. A second consideration is the price per share. We're going to be getting into contracts for the potential exchange of shares, buying or selling shares. And if it's a high price stock, that can be a lot of money. If it's a very low price stock, it's less money. But there can also be just issues with setting up the options trades. There aren't very many choices on very low price stocks, and those types of stocks tend to be a little bit more volatile. So maybe traders might be looking for their own personal sweet spot on price per share. So liquidity, commonly a consideration. Price per share, commonly a consideration. Also, what's happening on the stock chart. Some traders use charts to help them plan a trade. And I'm not going to get deeply into charting today, but for some at least, they might look to see that the stock appears to be at least going higher if they're doing a bullish trade. So I want to zoom in on what's been happening over these last few weeks. And then we're going to plan a trade that's going to be concluded within 2 or 3 weeks. All right. So here's what I see. What some technical traders might note is that our stock has been running up and then it's been pulling back. It's been running through little cycles. It actually pulled down here. It's running up and then it's pulling back. And to some, reaching these what we call higher highs and higher lows may be to them the definition of an upward trend. And even just today with a white candle, it looks like prices are continuing to climb. So let's just say that our trader has this bullish outlook on Apple. All right, well, let's go place a bullish trade. And a long call vertical spread, which is what we're going to be doing today, is a bullish trade. But the way that I'm going to structure it is it's going to have a high probability of success. But if it goes wrong, it can lose a lot of money. That sort of sets the fuse on a big bomb. I mean, it's kind of dramatic sounding, but I want to be realistic about risk here. And so in the effort to avoid something coming in, let's call it its own little landmine, in an effort to minimize the risk of something big triggering that as much as possible, maybe we want to be aware of earnings. So I'm going to go up here to our little chart settings. There's a tool on Thinkorswim that allows us to see earnings in advance. First thing that we might do is make sure that we can see out in the future here, have some extra space out to the right of the chart. That can be done using these little double-headed arrows down here. We can just change the right expansion settings and make sure that we have some extra space. 29 trading days is what this means. So that's what I've done here. Like if we set this to 30 trading days, we click apply, and it just creates some space out there. Now, the next thing that we want to do is go up here to the little chart settings icon again and go to equities or stocks and check the box that says show corporate actions. A corporate action is an action that a corporation might take that could have an impact on its stock price, like splits or dividends or earnings announcements. So let's apply that to our chart and click OK. And when we do that, we see this little icon. Now, with some of you, probably a lot of you, that icon may already be there. You might not have to go through that step, but I wanted to get it on the recording so you can go back if you need to see how to set that up. It's now on there. But this now tells us that right around the corner on July 31st, there's an earnings announcement. If we set up this trade that I'm going to set up, that can cause some pretty good damage in the portfolio if it goes wrong quickly, maybe the trader wants to sidestep that. So let's keep July 31st in mind, and I'm going to go start to plan and place a trade, a bullish trade, that doesn't go through July 31st. So we go to the trade tab, we type in our symbol here, and I'm going to go down to the options chain. These are all the options that are available, and I can see when those contracts expire. 11th of July, hey, heads up, tomorrow, it's my birthday. 18th of July, 25th of July, 1st of August, that goes beyond earnings. So let's just keep ourselves to these first few. And I'm going to push this out a little bit further. Let's go to the 25th of July. Going really short term, when trading high probability trades, there tends to be not much profit in those, not much profit potential. They might consist almost exclusively of risk. So I'm going to go with this one, 25th of July, and start to build our example trades. So we have our priorities here. Thank you, Papa. Appreciate that. Wondering, 53 years old. Time goes by quickly, right? Anyway, let's plan and place our example trade. And this is a long call spread. I'll explain why it's called that as we build it. But really, it just begins life as a long call. When a trader is bullish, there are two basic approaches in options to trade bullishly. We can buy call options or sell put options. Well, this webcast series is about buying stuff. So I'm going to take the selling put out of the equation, And we're going to buy a call here. But I want to do this in a high probability way. So on Thinkorswim, let me scroll up just a little bit again. Scroll up. There we go. Down the center column here, we can see the available strike prices, prices at which we strike a deal for the potential exchange of shares with another trader. And I'm going to look at a couple of things. I'm going to look over here at Delta, and I'm going to look at my strike prices. But what does Delta tell us? Well, Delta can tell us the degree of leverage on an option. It can tell us how much that option might make or lose if the stock goes up or down $1. But it also can give us the probability, and high probability is our focus here, the probability that an option will expire in the money, retain some value at expiration. Martine says, why bullish? Martine, if you missed the first part of this discussion, we went through a market and stock analysis of why bullish, so you can go back and check that out on the archive. Two Continents, again, says, can you show how to set up the earnings on the chart again? Rather than doing that, in the interest of time, we only have 19 minutes left in this presentation, I just want to emphasize these sessions are recorded, and you can go watch. A couple of them don't get posted, but the vast majority get posted to our YouTube channel. So just go to Trader Talks Schwab Coaching Webcasts on YouTube, and you can find those. All right, anyway, but if I see a delta, for example, of 78, or it was just a moment ago, 79, there we go. That tells me that there's about a 79% probability that this contract retains some value at expiration that's in the money. So if I'm going to buy it, maybe that's a good thing. So how about we zero in on that one? Let's look at potentially, let's buy the 25th of July. What is that? The 205 call. And that looks like that's trading between $9.85 and $9.95. Let's call it $9.90. So if we stopped right there, we would actually have a bullish trade. We're paying $9.90 or $990 for the right to buy 100 shares of Apple at any time between now and the 25th of July for $205. So if the stock goes rocketing up, hey, we already locked in a purchase price of $205 for the next 15 days. That's not a call spread, though. That's a long call, but it's not a spread. So at the same time, what we're going to do is sell. Let's stick with the same stock, the same expiration time, but a different strike price. Let's look at selling maybe the 210 call. That 210 call is trading between 605 and 615. Let's call it 610. So what are we doing here? Well, when we sell a call, we receive a premium. Somebody's paying us. Ooh, that's cool. So we're collecting $610. That's great if they were just giving us money for the kindness of their hearts. They're not. What we're really doing is accepting that payment, but taking upon ourselves an obligation. This obligation is someone else out there has the right to buy shares from us for $210. And they have that right through the 25th of July. So the net between those two trades that we're doing is that we have the right to buy shares for $205. We have the obligation to sell shares for $210. Let me ask you, if you had the opportunity, if somebody says, hey, Cameron, you want to buy shares at $205 and sell them for $210? The answer is yes, right? I'm not saying that we should do this trade because it may or may not work out. But if we wind up buying shares at $205 and sell them at $210, that's a $5 profit potential. It would be a $5 profit potential if it were a free trade to set up. It's not a free trade. We spent $990. We received $610. So what does that leave over for the theoretical maximum gain on this trade? And by the way, if this is your first exposure ever to spread trading and you're thinking, Cameron, I'm holding on by my fingernails, I'm not catching it all, that's the way we all were the first time and the second time, probably the third time. This takes a little repetition. It takes some practice. Don't put that pressure on yourself. I'm not putting it on you. Don't you do it. Instead, just take your time learning this. It's going to take some repetition. This is just an introduction. That's okay. But our theoretical maximum gain is, well, if we buy at $205, but we're required to sell at $210, that would be a $5 profit minus what is the difference here? $3.80 that it took to set this trade up. That leaves us with $1.20. Yeah, see long, it leaves us $1.20. Does that sound like a lot? Doesn't sound like a lot, but actually this is not a highly expensive trade to place in the first place. We're not tying up a lot of money in this trade. What's the net cost of this trade? Also, the theoretical maximum loss. And this is where you're going to say, if this is your first time seeing this, you're going to go, this trade is crazy. Well, we spent $990. We received $610. We can lose if this trade goes haywire, $380. What does that leave as a return on risk or return on investment? In these cases, they happen to be the same thing. Well, if we stand to make $1.20, but we can lose $3.30, the $3.80. What does that work out to be? Let's get our calculator up here. 120 divided by 380 is 31.6%. So I know it's easy to say, oh, $1.20, that's not very much. We're setting up a trade here where if it goes well, in the next 15 days, we might make 31.6%. That's actually a very high reward scenario, but clearly there is risk. So Dan says, is the multiplier always 100 for small sized accounts? So Dan, that's considered a standard contract, 100 shares. So the answer is actually no. There are some stocks that have what are called non-standard contracts. We just do the standard contracts. There are only a few out there that are non-standard, but yeah, just plan on 100. How could we reduce the cost? Well, maybe trading lower price stocks, but actually it really comes down to, in spread trading, the distance between the spreads. Now, that's if nothing else happens. There's definitely some other stuff we need to talk about where it can change the amount of investment dramatically, okay? But yeah, there's a 31.6% reward potential in this trade, and this trade has a high probability of success. Let's look at that. If we stand to make $1.20, I wonder what the chances are that's going to happen. Well, for our spread traders in the audience, they know that with a 205, 210 call spread, the preference here is for the stock to be above $210 as we move toward the 25th of July. Where we'd like to be 15 days from now is above 210. Guess what? We're already above 210. We only have to stay above 210. And as a matter of fact, looking at that delta as a guide again, there's about a 62% chance. Let me give myself just a little bit more space here again. 62% probability that is the precise outcome. If we just put this trade on and let it go, about a 62% chance that we make our $1.20 or our 31.6%. What do you think the odds are that we lose the full 380? You might say, well, 62% chance of making all the money. There must be a 38% chance of losing all the money. Nope. To lose this money, we'd need to be below 205, not below 210, but below 205. And look at our 205. There's a 78% chance that still retains some value at expiration. Or in other words, there's only a 22% chance that we lose, that we incur the maximum loss on this trade. So a 62% chance that we make $1.20, about 22% chance that we lose 380. But an earnings announcement can come along and flip this on its head very quickly. That's why some traders prefer to just not trade this sort of an approach over earnings. I think with this, it's sometimes helpful to just map this out on a chart. So first thing I'm going to do is draw a line here. Let's go in a little closer. Let's change our time frame. Let's change this to like a 3-month chart. There we go. And I want to draw in some lines here. One at 205, one at 210. So here's today's candle. Let's go down here to 2010 and just draw in a line there. And I'm going to carry that out to, what was it, July 25th. These contracts expire. So let's go out to July 25th. And then let's draw one in at 205 down here. There we go, out to the 25th. If it's helpful, I'll draw a line there just to show you. That's when our contracts expire. This represents our 210 strike. This represents our 205 strike. And where we would like to be, we'd like to be up here. Where we don't want to be is down here. Okay, so let's make that red. Go. That's where we don't want to be. So here's where I think it can be useful. Let's talk this through. What can happen? Let's talk about the fun part. Let's talk about the not so fun part. Let's say that our stock just goes, oops, I don't want to draw another rectangle. Let's say that our stock, which is right here, it just ticked upward. Let's say it keeps going higher, and by July 25th, it's still above 210. Well, let's talk through these contracts. If our stock is up here at, let's say, 215, and someone has the right to buy our shares from us for 210, well, they have the right, but do they have the motivation? What do you think? Yes. If you can buy a $215 stock for 210, it sounds like a good idea. It's because it is. So our trader buys the shares from us for 210, and we say, oh, wait, where am I going to get some shares to deliver for 210 bucks? Oh, yes, I have the right to buy those same shares for 205. So we buy the shares for 205, we sell them for 210. That would be a maximum realized gain. That'd be a $5 profit minus the $3.80 that cost to set the trade up. There's our $1.20 gain. That's fun. What's not so fun? What if the stock collapses in value? Let's say it falls down here below our vertical spread, and it's down at 200 bucks, or just somewhere below 205. Go back to the logic chain. If someone has the right to buy our shares for 210, but they're only worth 200, do they have the motivation to do that? Nope. They're going to say, Cameron, I don't want those shares. Most likely. And somebody might get a wild hair and say, I'm going to buy the shares anyway and bail us out. It's probably not going to happen. They're going to say, Cameron, I don't want the shares. Keep my 610. Okay. Well, at the same time, we have the right to buy shares for 205 that are only worth 200. That investment is worth Zippo at that point. So we lose our 990. So at the end of that day, we've collected 610. That's a realized gain. We've lost 990. That's a 380 loss if the stock falls. We don't want it to fall. And we don't want an earnings announcement to come in here and cause it to drop rapidly and lose money faster. So, yeah, that's kind of a worst case scenario. So falling below 205. Now, if we add these numbers together, 62% probability of maximum gain, 22% probability of maximum loss, my math says that's only 84%. Where's the missing 16%? Well, that's somewhere between max gain and max loss. What if, let's paint this scenario, let's say we come down here at 207.5 and we hit expiration. We have the right to buy shares at 205. They're worth 207.5, so we buy them. Yes, Chanel is asking exactly this question. What if it closes in between? Yep. So we buy shares at 205. They're worth 207.5. We're now the owner of the shares. Someone else has the right to buy those same shares from us for 210. They'd be overpaying. They say, Cameron, keep your shares. All right. So now we just own the shares. Couple of things to bear in mind there. We now have a $2.50 unrealized gain on the stock. We bought it for 205. It's worth 207.5. That's nifty. $2.50 of built-in equity there. But we spent $3.80 to set that up. So we're actually underwater on that by about $1.30. It's not worst case scenario. It's not best case scenario either. As a matter of fact, here's an important line. Below 210 is, we don't want to be below 210. We want to be above that. If we go more than $1.20 below 210, that's our break-even point on our trade. That's where we're now possibly losing more money on the trade than we stood to gain. So that would put us at 208.80, somewhere around here. Just draw a line there. That's helpful. Just helps us visualize where the break-even point is on this trade. All right. So those are sort of the facts of the trade. I wanted to lay them out, get them on the recording so that you can go back and you can revisit these if you need to. If it's your first time doing it, our veterans are like, Cameron, you're boring me to tears. I already know all this stuff. But for first-time learners, this is important math to be able to perform, because we need to be able to know how much we can make, how much we can lose, what are the probabilities of success or failure, what's the break-even point of the trade, what's the return on risk, all important stuff. So now let's go place our trade. But I'm not just going to leave this 380 entirely exposed. For some traders, they're bullish. That's the reason why they're taking the trade, but they recognize this stock could turn, it could go down. We could be losing value instead of gaining value. And so they may put in what's called a stop order, a stop the bleeding exit order to get out if the trade is misbehaving. So I'm going to include one of those. And this is just it's just a very general rule of thumb. But for some high probability traders, recognizing that there's a larger risk than reward, they try to minimize that risk as much as possible. Maybe they put in a stop if they start to lose more than half of their initial investment. In that case, it would be, instead of losing the 380, maybe we try to trim that to 190, half of that investment. Let's put in a stop there. So let's go place our trade. Here's how that trade would, it's one of the ways the trade could be placed. On Thinkorswim, there's a nifty little function where when we have multiple contracts, we can just go to those contracts and we're going to hold down our control key on our keyboard and start clicking. So I'm going to hold down my control key and I'm going to click on the ask price for the option that I intended to buy. Click on the ask price, creates a buy order. And then I'm going to go back up to the option chain. Let's just minimize this order for a second. Back up to the option chain and click on the bid price for the one that I intend to sell while holding down the control key on my keyboard. There we go. That creates our vertical spread. It's called a vertical spread because, well, it's called a long call vertical spread. Long just means we're net buying something. Call, we're using calls to create it. Spread because there's a difference. There's a spread between 205 and 210. And vertical because 205 and 210, if you envision those prices, one is above the other. Anyway, that's just a little bit of trivia. So it looks like it might cost us, maybe we have to spend up to 370 or 375 to get into this trade. Not 380, maybe a little bit less costly, maybe leaving us a little bit more reward potential. How about just to keep the price consistent? Let's say we're willing to spend up to 380, but if it falls by half that amount, we're going to get out. So instead of just putting in a single order, let's put in a first triggers sequential order. That just means if our first order fills, a sequential order will go into effect. And as I change that order type, I can right click on the original one and create an opposite order. And this one is going to be our stop order to stop the bleeding, hopefully at 190. Stop order is not a guarantee that will sell for a specific price. This is just our trigger price. It may actually sell for less than that, but if the value ever falls to 190 or below, it'll trigger a market order to get out here. Guys, that's going to do it. Let me click confirm and send here. I'm going to buy this one. We're just doing one example contract here, $380 investment. The 205, 210 call spread. We're going to have a stop in at 190. Otherwise, we're going to let it work and try to get to that 120 profit. There are commissions to be paid, 65 cents per contract to get in, to get out. But just remember that due to potentially wide market conditions or liquidity risks at the time of activation, the stop order may be manually substituted with a limit order on activation and worked until filled. And just there's a heads up that please note that we've selected a weekly option series with a non-standard. It's not the third Friday expiration date. Send that off. Guys, we've accomplished what we set out to do today. Time for me to let you go enjoy the rest of our educational offerings for the rest of the day. But I do have a couple of suggestions for you. First of all, if you haven't done this already, make sure that you're subscribed to our YouTube channel. Go down and click on the subscribe button right now. It only takes a second. It doesn't cost anything. And this channel is where we house our playlists for our webcasts. And you can also join the live streams. Another thing that I would strongly suggest is to follow Brent and me and your other favorite presenters on X. If you have an account with X, it's another great resource. For example, I just published a 2-minute video here about how to link up different tools on Thinkorswim so your symbol moves around with you as you move around on the platform. So that's a great resource. Brent can be found at Brent Moores CS. You can find me here at Cameron May CS. Thanks everybody for clicking that thumbs up button. That's always appreciated. 468 people watching. We've already had, how many have clicked that like button? 88? Thank you. That sounds like applause to your presenter. It also gives us a boost in the YouTube algorithm. And as a final heads up, there is a survey that Brent has, appreciate this, he has reposted several times in the chat window there. It's a very short survey, 2 multiple choice questions and a comments box and a suggestion box. If you fill that out, I promise you, I will read that data. I'll read your comments, and it's always helpful. All right, everybody, thanks for giving me your time today. I will see you again next Thursday. We'll follow up on this, this trade and other trades. I have other webcasts every single day of the week, so look for me on the YouTube channel. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.